you're going to see a massive amount of demand for apartment complexes in these hot markets, but you're not going to see as much supply. So you're going to see rent growth tearing back up, or that's what we believe, and that's what all the experts and the reports that we read are saying. You're going to see, so rental rates are going to tear up, occupancy rates are going to tear up, there's going to be more demand. And so that's going to be a huge plus for the industry. Welcome back to the Keeping It Real Estate Show. I'm your host, Mike Roeder, and today we're going to spend a few minutes talking about something that doesn't always get the front and center in the multifamily investing world, but it absolutely should, and it's job growth. So job growth, market resilience, and how all of this ties into choosing the right market and managing risk is what we're going to talk about today. So let's start with the current backdrop. So the latest data from the Bureau of Labor Statistics shows that U.S. non-farm payroll gains are increasingly modest at best. And you've probably heard this in the news. New jobs have kind of fallen off a cliff. And for example, the August 2025 report showed only about 22,000 jobs added, which is well below expectations. And meanwhile, benchmark revisions showed that over the last 12 months, through March of 2025, the economy created about 911,000 fewer jobs than earlier estimated. So this is a big flaw, first of all. When they're saying, hey, this many jobs were created this month, this many jobs were created this month, there's a lot of flaws in those estimations. And so when you take a look, they've revised the past year down by almost 1 million jobs. That is a huge impact and difference, in projections versus what actually happened. So, you might be thinking, what does that mean for multifamily real estate? So first off, a cooling job market, it's a risk for rental housing. When people aren't getting hired or they fear their job security, so they might fear that they're going to be let go from their job, it constrains demand for rentals and suppresses rent growth. So as an investor, you really have to pay attention to the employment fundamentals in the metro that you're targeting. Each submarket, each city, each state is significantly different when it comes to job growth and job loss. So you really have to tune into the actual submarket and market that you're investing in. Now, the flip side, so when a metro has strong job growth, for instance, so the exact opposite of job loss, diverse industries and population migration are working in your favor. And that's where you get something that's called resilience. So two markets that we often reference on the show, two markets that we invest in, include Dallas, Fort Worth, and Nashville, Tennessee. And if you think about those markets, DFW, it's ranking among top US markets for building and growth. So over 40,000 new apartment units have been delivered in 2024, strong commercial construction spending, which is always a plus. Now, the unit side of things, there's been oversupply in both DFW, Nashville. You look at Austin, you look at Charlotte. A lot of these major MSA markets that are typically pretty hot have had a lot of supply over the last year or two. And so that has impacted the amount of rent that multifamily owners can get. Now, the huge plus is new permitting for new construction has fallen off a cliff. It's fallen by about 50%. So when you go out to, later in 2026, 2027, 2028, you're going to see a massive amount of demand for apartment complexes in these hot markets, but you're not going to see as much supply. So you're going to see rent growth tearing back up, or that's what we believe. And that's what, all the experts and the reports that we read are saying. You're going to see, so rental rates are going to tear up, occupancy rates are going to tear up, there's going to be more demand. And so that's going to be a huge plus for the industry. Now, most economists, going back to the jobs, they estimate that each new job in a market creates demand for roughly about a half to one new housing unit. And that depends on wages, depends on household size, depends on the market supply constraints. But that's a huge thing. So if you're adding, let's say 30,000 jobs, you might need 15 to 30,000 units because of those new jobs that are coming into the market. So again, that's why we choose really hot markets that have a lot of business growth and have a lot of population growth. And because these markets are growing and diversifying, So tech, healthcare, logistics, corporate relocations, even when national job growth softens, like it is this year in 2025, these markets tend to bounce back or at least hold their own in a downturn, in the job market. So that gives you, as a multifamily investor, whether you're buying a project on your own or you're just investing with someone else in one of these markets, it gives you a higher chance of stable occupancy, gives you a higher chance of rent growth. It gives you the opportunity to have less downside risk. So consider that all when you're going into a new market or when you're considering an investment. Now, let's talk about the pitfalls. So if job losses hit, let's say a major employer in a small market, vacancy can spike, concessions can grow, rent growth may stall. And also when the national job growth outlook weakens, that tends to weigh on overall economic confidence. However, there's also counterintuitive advantages. So when job growth slows significantly, what does that do? It raises the likelihood that the Federal Reserve will lower interest rates in response to economic softness. So here you have on one hand, you're bumming out a little bit because the job reports is coming in soft and that people are losing their jobs across the country or that employers aren't hiring as quickly and maybe there's not as much wage growth. On the other hand, the plus is the interest rates are more likely to come down. And what does that do for multifamily real estate? It allows you to have a lower debt payment. And then even if you're locked into an interest rate, it really compresses the cap rate. So it boosts the values of these properties up. Reason being, when you go to buy a property, if you can get a lower interest rate and more leverage on the property, that's going to be more beneficial for the buyer. So that asset becomes more and more valuable as interest rates go down. And so that's what we're expecting moving forward, is we do think that there's a very good likelihood as jobs are lost or as the economy doesn't add as many jobs, that the interest rates will likely tear down. Now, it doesn't happen overnight. That takes time. But that's a very likely scenario as we move into 2026, 2027. So lower rates, what does it mean again? Cheaper capital, refinancing opportunities for these properties, improved cap rate spreads, which we just talked about, which all benefit multifamily investors and commercial real estate investors significantly. So the cycle plays out like this. Strong job markets equal strong demand for housing, which equals rent growth. Weak job markets equals potential softness in rents and possible, interest rate relief, like we talked about. And the key is picking markets that lean toward resilience and a diversified enough job market to weather, any shocks that the economic system has in its pipeline. So while Dallas and Nashville are strong examples of diversified employment, it's still important to point out the general principle. Markets that rely heavily on one industry, they can swing violently. We've had firsthand experience with this. So think of markets that are dependent on energy, Midland, Odessa, Carlsbad, New Mexico, potentially markets like Houston that are a little bit more oil dependent. They tend to swing a lot more. So if oil drops off the map, for instance, like when COVID hit, oil went negative for a bit and it, substantially went down, if you look at the average over 2020, 2021, and so on. And so markets like Midland, Odessa, and Carlsbad, New Mexico, all of a sudden you have all of the oil companies that stop production or they tear down the amount of workers that they have in those markets. And so you're dropping rents, your occupancy is declining. You just don't have the demand to support all of the supply in those markets. So it can impact you significantly. So what we look at now is we want a diversified job market. If the market is too dependent on one industry or just a couple of industries, it's not something that we're going to invest in, even if it looks like the projections are really, really solid, because there's just too much downside risk. A couple of other things to consider when looking at diversification: college towns. We've had first-hand experience with this where the college enrollment plummeted. We had a property right next to campus. This was actually one of the first apartment complexes we ever owned. And it affected our rents and our occupancy significantly because all of the properties around that campus started to convert to family housing instead of student housing because the enrollment was down so much. And so that, it basically plummeted our value because we couldn't get the rents that we thought we'd be able to get. Military towns, if all of a sudden you see a huge cut in military spending, or if that military base up and leaves, or takes a good portion of their team to a different market, that can really, really impact a town. So we typically write off military towns. We do not invest in towns that are very, very dependent on military. Obviously, you can still do well in those cities, but it tends to be a lot higher risk. Or cities or submarkets that are dependent on tourism. You look at what happened during COVID. All of a sudden, tourism dropped off a cliff, and here you are holding the bag, with not as much demand. So just make sure that you have a very diverse job market when you're going into a new market. So let's discuss some key industries to watch. As you're looking for diversification in job markets, healthcare. I'm going to use Dallas and Nashville as an example. Dallas, you have Baylor, you have UT Southwestern, you have Texas Health Resources. Nashville, you have HCA, Vanderbilt, Community Health Systems. Healthcare is one of the most stable, non-cyclical demand engines in real estate. So that's one huge reason why we do invest in Nashville. There's been a ton of growth there, but not only that, there's over 500 medical companies in that city, and that just gives us extreme confidence that there's always going to be a significant amount of demand, in that submarket or that market. Tech and corporate. So Dallas, we have fintech, IT, you have software, corporate headquarters. Nashville, you have Oracle, Amazon, tech startups, and tech jobs create high income renters and they attract in-migration. So two huge bonuses. Any of those high income renters, those are typically more stable jobs, and it creates a lot of demand, in the city. Plus, you have well-qualified renters to choose from potentially, and then it attracts the in-migration. So it attracts other people, other companies that are coming, to that city or that submarket. Manufacturing and logistics, also another very important aspect to look at. When you're looking at jobs. For Dallas, you have the DFW airport corridor, which is massive. Allianz, Texas, one of the largest logistic hubs in the United States. Nashville, you have automotive manufacturing, so Nissan, GM, logistics due to the I-24, I-65, I-40 highway access, so it's very centrally located. Those are things that we're looking at. And then education and government, also important. You want to be a little bit careful on the government side if it has too much of a presence, but typically some pretty stable jobs there. So the lesson is, DFW in Nashville, they outperform because no single industry controls their job market. And that's exactly what we want as investors. So lastly, let's talk about a wild card here. I'm sure this is probably on all of your minds. I know it's on our minds. It's artificial intelligence, AI. And AI isn't just about robots. According to research, AI will both displace, but it'll also complement jobs as we move into the future. So some roles might shrink, others are going to be created. And for multifamily investing, that means markets that are positioned for the future economy, so think tech, logistics, healthcare hubs, may benefit disproportionately from this AI movement that we're seeing right now. And we're at the tip of the iceberg right now. So for example, in Texas, the Federal Reserve Bank of Dallas says AI-related change could be positive or negative for workers. Soft skills, human interaction, they all still matter. So the takeaway is job growth matters a lot when selecting your market. Look for metros with diversified, resilient job bases and positive migration patterns. Recognize cyclical nature. So a slowdown isn't the end. It may bring opportunity as well, like we were talking about for interest rates and values of properties. And then it's also sub-market dependent. So make sure that you're tuning into the sub-market that you're investing in and not just the national news. A few more stats on AI that I wanted to talk about. First off, AI is improving by 27x a year. This is massive. If you think about anything in life, if you can get 27 times as good in 1 year, I mean, that is just an unbelievable stat. And that's how we're progressing with AI right now, which is absolutely massive. Another stat that I recently heard at a family office club event was that 99% of intelligence will be from AI in the near future, in the next handful of years. So that means that almost all of the intelligence around the world is going to be coming from AI. And then also 40 million robots are currently in place in the world right now. And that number is going to be over 4 billion robots by 2040. So this is a huge, huge push. And then finally, future economic shifts like AI. They're not just hype, they're real. And they're going to influence which markets win in the future and which markets lag. So pay close attention to that because it is coming and there's rapid advancement in AI every single year. So in your multifamily strategy, again, give job growth and market employment fundamentals the attention you give rent growth and cap rates. Sure, rent growth and cap rates, super important, but the job growth and the market employment fundamentals could be even more important, as you look into these markets to invest, because over time, it's really those fundamentals that separate the winners from the losers. So that's it for today's episode of Keeping It Real Estate. Please leave us a rating and review if you enjoyed today's episode, and have a great day.